Hi, this is Joe Rabil from Rabil Stock Research with your Daily 5. For the past 30 years, I have been providing research and consulting to institutional investors. My clients range from deep value to some of the biggest momentum players out there, as well as everything in between. And the reason why that's important is that over the years, I've noticed some relationships that have developed which can provide pretty good insight into the overall market conditions. In today's environment, these relationships are throwing off some warning signs here. So let's go ahead and get into the Daily 5 and talk about this a little bit. So the first chart is the TNX, the 10-year Treasury Yields. And what I've done is I've got a weekly chart, but I have overlaid this green line. I've overlaid a monthly 18 MA. I've got the 18 and the 40 MA as well in magenta and blue here. And so obviously what this is starting to show is a pretty big reversal developing in the rates. And it started out as just sort of like a elimination of the downtrend. We kind of stopped going down. And it looked more like it might want to be in a trading range. But if you notice what's been taking place just over the last 6 months, notice how this 18-month line was declining and is now rising underneath and providing support for the trend. And actually just today, we're starting to break out from this sideways consolidation pattern. The other thing that I would point out is if we go back and look, it's been quite a while, been a few years since the MACD line has been able to go up enough to be able to pull back and hold the zero line through a correction phase and still hold above that level. And that I think that provides a little bit of a positive backdrop as well. And then we have overall pretty good condition in place when I'm looking at the ADX, because it was a lot of strength to the upside. And then as we've gone through this consolidation phase, there really hasn't been much on the sell side. So, what this means, and one of the relationships that I would tell you is that obviously some of the value areas tend to perform better when rates are moving up and we see the growth areas get hit. And financials have been playing pretty well recently. But even today, we're starting to see the financials get hit, because what ends up happening is if rates start to go up too much, or at least if the market believes that rates are going to be going up, then it really has a pretty big negative effect on the whole market. And so I think we need to be careful here from the standpoint that, yeah, it looks like we want to head up towards this next 2 level, and maybe even carry up into the 225, 230 area for rates. And if that's the case, I think that's going to have a negative impact on all sectors. Now, I would still believe that some of these value areas are going to outperform, but they're going to have a hard time having an actual up move and in absolute terms. So I do think that's important to recognize. Let's go to the next chart, which is the Russell 1000 growth. And so this is a lot of the big names, a lot of the stocks that really where you've got your heavyweight holdings, the Microsofts and Apples and stuff like that. And what I want to bring up here is at the bottom, I've got the relationship of the IWF, which is the growth index, to the value. So that's the ratio I'm using, IWF to IWD. So it's the Russell 1000 growth versus the Russell 1000 value. And if you notice what's happened here recently, just starting late last year in about November, we made another peak in growth versus value. Growth was outperforming since May of last year and made a nice run, and then basically made a double top and has now been selling off pretty hard. And the reason why this is important is what I've noticed is that we can get these moves, these counter trend. Notice how we've had a lot of fluctuation in this line. There's been pretty strong directional moves where sometimes value is outperforming and sometimes growth is outperforming. But what hasn't happened during this period is a change in the trend for the IWF. If you notice, we've been making higher highs and higher lows. You can see that from the zigzag. You can also see the 18-week line here and the fact that we really haven't had a clean break. This is actually the most I would say, egregious break of the 18-week that we've had. This is our third week being below. We really haven't had that take place during the course of this up move. Now, the same things happened with IWD. IWD also hasn't broken down during these periods, but because there's so much of the big weighted stocks in the IWF, I'm watching this much more closely, and I'm looking for a sign that we're actually breaking this trend a little bit more convincingly than what we have. But if we get that to take place, we're probably going to see this line drop and not necessarily go through the ups and downs that we've been having. It could be a little bit more of a definitive move in favor of value. Now, like I said before, value could struggle on an absolute basis. So it could be very difficult to make money if this IWF breaks down. It could get very difficult overall in terms of the overall conditions. One other point I want to make, I'm just going to bring up this IWF with the 18 and the 40, and notice how the MACD has dropped off and didn't confirm the last peak. Also notice how ADX over the last 6 months has not been confirming the new highs. So that makes a trend line break that much more important to me. It's telling me that this index is losing some strength, and it might be set up for a little bit more of a severe correction. Let's go on to the next stock, or market, I should say. And hold on just a sec. Let me switch this. So here I've got the IWM. So this is the Russell 2000. And so this index tends to be a leader when the market's going up. When the market's in a very sound, strong condition, this tends to be a stronger position, and it tends to outperform the S&P. And when there are periods where it's underperforming is when the market tends to be a little bit more vulnerable. Now, I mean, we're at a pretty critical level for this IWM. We're sitting at this support level. It tried to break out, though. This is what bothers me a little bit, is that we're in a pretty good position. It had gone sideways. It looked like this was just a correction on a relative basis to the S&P. And then when this broke out, it just failed miserably within a couple weeks and has had a pretty hard down move. So it puts it in a position where now if we take out the low here, I think there's some risk. We've got a little bit of an air pocket between this level and where we broke out from. And it would concern me if we end up breaking the 18-month line and this big area of support. I've just noticed over the years, I've worked with a lot of small cap managers, so I've watched this relationship. And when this line is making lower lows and lower highs, it tends to be a less desirable market environment overall. Let's look at a couple sectors I want to point out very quickly. Just using consumer discretionary as a more aggressive area, a growth area. This is in an uptrend still. It hasn't officially broken, but if we come down through 189, something like that, and show the relative performance to the S&P continuing to weaken, I would be pretty concerned about this, and it would probably be telling us that the IWF wants to break down. Let's look at one other chart, though, that I think is actually even a little bit more important. If we look at the period, so this is the consumer staples. Through this period, this index was rising. It was making higher highs and higher lows, but look at what the relative strength was doing through that period. It actually, even though it was moving up on an absolute basis, it was underperforming the S&P. Now we're actually in a period where, yes, it's moving higher, but look at what's happening to the relative strength line. This relative strength line is now rising. So I think this is a pretty bullish setup for consumer staples, and it's telling us people are being a little bit more defensive. Money is sort of flowing into the defensive area. My your daily 5 from last week actually showed money was flowing into some of these defensive areas if you go back and look at the 5 stocks that I brought up. So anyway, I thought this was worthwhile. I just thought I wanted to go through and give you a little bit of a glimpse into some of these sectors as well as indices that I think are showing off some things that we should be concerned about. So that's the segment for this for today. I hope you enjoyed it. You can contact me through LinkedIn or find my research on rabilstockresearch.com. In addition, if you like to learn more about trend, MACD, and ADX in multiple timeframes, I have a YouTube channel and a book called Invest Like a Pro, which delves into this subject. Have a great trading day, and I'll see you next time.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.